Hi, this is Marie from Legacy Publishing. Today we are going to focus on investing in gold. Chuck, what is your current outlook for gold?
Marie, historically, there is a strong inverse relationship between the value of the US dollar and gold prices. The US went off the gold standard in 1971, and the dollar has been falling in value ever since. The value of gold and the dollar normally move in opposite directions. You can see from these price charts that as the dollar has been declining, gold has been rallying in price. As you may know, the U.S. is the world's largest debtor nation. As U.S. debt and deficits continue to balloon, they exert downward pressure on the dollar. This trend will likely continue for some time. Gold protects investors from a falling dollar. It provides an excellent way to protect your wealth and maintain purchasing power, which will continue to erode if the long-term slide in the US dollar continues. White House projections this week estimated that the US will incur annual deficits in excess of $1 trillion for the next 10 years. The Federal Reserve has tripled the size of its balance sheet. This deficit spending will lead to a sharp increase in the money supply, which in turn points to an increase in inflation and higher gold prices. Now, I'm not a gold bug, but I think the impending increase in inflation will result in higher gold prices, and I think it is prudent to hold a position in gold to diversify your portfolio.
Chuck, can you tell us about your strategy for investing in gold?
Marie, I think one of the best ways to invest in gold is to buy the gold ETF, symbol GLD, and sell monthly call options against your stock. This strategy can produce profits if the price of gold increases, remains flat, or even decreases. The gold ETF holds gold bullion and not gold mining stocks, so purchasing the ETF allows you to own physical gold. Unlike stock investing, when you own gold, you don't receive any dividends, and there are no corporate profits that produce value for shareholders. When you sell a call option against the gold ETF, however, cash is immediately credited to your brokerage account. So selling monthly call options against the ETF is a great way to generate cash dividends for holding gold. The gold ETF and its associated options are very liquid with narrow bid-ask spreads, so it is a good trading vehicle for small traders. My brokerage confirmation shows that I purchased the gold ETF at 93.40 and sold the April 94 strike call at 3 points. This option expires in a little less than 1 month. This creates a buy right trade. You can see from my brokerage confirmation the sale of the call option resulted in a $291 cash dividend being credited to my brokerage account. This buy right analysis shows that the profit potential on this trade is $360 if the gold ETF closes at or above the 94 strike price at option expiration. This would result in a 4% return at option expiration. Now, the goal of this strategy is to sell monthly call options against the gold ETF to generate monthly income. The analysis shows that selling a monthly call option with a similar option premium has the potential to generate approximately a 58% annualized return, assuming the gold ETF closes at or above the strike price of the short call at option expiration.
Chuck, do you use the monthly buy right income strategy with other commodities?
Marie, the monthly buy right strategy can also be used with other commodities, such as the crude oil ETF, symbol USO. My brokerage confirmation shows that I purchased 300 shares of the crude oil ETF at 31.70 and sold 3 of the USO 32 strike calls at 1.85 points. These options expire in a little less than 1 month. This created a buy right trade or covered call. The brokerage confirmation also shows that the sale of the 3 call options resulted in a $544 cash dividend being credited to my brokerage account after commissions. This buy right analysis shows that the profit potential on this trade is $215 per contract, which results in a 7.2% return at option expiration if the crude oil ETF closes at or above the 32 strike price. Again, the goal of this strategy is to sell monthly call options against the crude oil ETF to generate monthly income. This analysis shows that selling a monthly call option with a similar premium has the potential to generate approximately a 105% annualized return, assuming the crude oil ETF closes at or above the strike price of the short call at option expiration. So to summarize, the monthly ETF buy right strategy can provide a great return with relatively low risk. The strategy does not require a large price movement in the underlying ETF to be profitable, providing an excellent risk-adjusted return. Going forward, this strategy provides a good return even if the price of the ETF remains flat.
Well, Chuck, I hope our viewers were able to gain some insights into the monthly income strategy. It appears this is a great way to invest in gold. I want to thank everyone for viewing, and I am looking forward to our next presentation.